Hello and welcome to our next session. In this session, we'll be talking about macroeconomics and the current price bubble, asset bubble, inflation, and market trends in a very, very broad 20,000 foot view. And to do that, we will be discussing two articles, one picked by Dr. Imran and one picked by me, to look at the author's impression or summary of the market and give our own analysis. Any thoughts from you, Aqueel, before we begin?
No, nothing special. We are going to discuss Jeremy Grantham, who is a very famous investor, his opinion about current market. And I think then you have another article to share.
Yeah, and I have it from Lynn Arden, which is a rising star in macroeconomics and market forces review. She's famous from being very active in the Bitcoin space, but she's really more of a macroeconomic analyst who's also sold on Bitcoin. So, but that's only a small part of what she does. All right, let me start with the first one with Jeremy Grantham, and let me share my screen here. All right, Aqueel, why don't you go ahead first?
So, in the beginning, there's a summary, which is kind of a summary of the whole article. And it says, it talks about super bubbles. And he says that there are bubbles and then there are super bubbles. And everybody knows about bubbles. And he basically said there have been three super bubbles in the last 100 years or so. And in those super bubbles, there's a massive drop in the markets. And fundamentally, their nature is different than the regular bubbles. So he basically says that markets about 85% of the time behave in a certain way. And the other 15% of the time, they behave very much differently. And 12% of the time of those 15%, people are very exuberant and markets are very irrational. And the rest of the 3% of the times, market can drop massively. And he basically called those events as 2.5 to 3 sigma events, basically. So
let's define some of these terms. So bubble is when there is an increase in prices of items, whether it be equity, whether it be stocks, whether it be assets like real estate or commodities like gold or oil. So everything has a price valuation which is going higher and higher, not because of any significant change on the underlying asset or equity or item, but because of people's willingness to pay more for it. And that's what we're calling a bubble. Now, a sigma event is something that happens which is way away from the median. And then, it's like standard deviation, you're towards the tail end. And then 2 sigma will be 2 times more away from the center per sigma, and 3x, 3 sigma. And then something when it hits 6 sigma, it's a black swan. It happens where it's like once in a lifetime of universe event that happens in terms of a 6 sigma probability. And I actually first heard that term with the 2008 crisis, if you remember, that long-term capital management. They came up with this black box equation that was doing much.
So that was 1990, Danish, in
19, yeah. So the event that happened at that time, the equation, I think the Black-Scholes equation or something like that, rated the probability of that event as 6 sigma. That's once in a lifetime of universe event that happened at that time. So, that's why this word sigma is a little unusual. But let me ask you this: one of the debates that happens in the Bitcoin circles is this idea of bubbles. The way the author is starting his summary, he kind of normalizes the presence of bubbles. He starts with this assumption, unspoken assumption. Oh yeah, market has bubbles, and then the market has super bubbles, and it just says, oh, this is a normal thing. But one of the debate that happens in the Bitcoin world is that this whole bubbling thing is not a normal natural phenomena. It's a phenomena that is due to the fiat currency, due to unlinking something real, underlying creation of what we call money, and that what actually has led to this economy, which keeps bubbling up every now and then. So what's your impression of bubbles? Why bubbles happen?
Well, I think bubbles are, they have been going on even before, when the before the you know gold standard was removed. Bubble has been going on much. They have a long history, going back to South Sea bubble and tulipomania, all of those bubbles. I think the underlying reason is basically the whole society kind of goes into this mania. Studying the crowd psychology probably can shed much more light on the nature of
Let me
bubbles
ask you
than.
this: did the bubble happen before European economic markets, before the Dutch markets and all those formed? Did bubbles happen in Roman time, in Greek
I
time?
don't know.
They had
Not to
money,
my
they had
knowledge.
coinage, right? And
Sure.
we talk about those coinage. One of the things that was different in Dutch market or European market was the gold certificate. The actual gold coins were becoming less and less often used, and the certificates were being issued by those people who later on became banks, which were basically depositors who will hold your gold coins and issue you certificates against it. But then nobody in the end had an idea how many gold coins they had and how many certificates they have issued. And they started issuing certificates way more than the gold they were actually holding.
No, I mean,
You know,
I would say that is a financial aspect of the bubble, but then there's a psychological aspect of the bubble also, which is basically in the whole society kind of goes into this state where everybody thinks that asset is going up, so they should jump into it. It's called bigger fool theory. Like, everybody basically buys something hoping that they can sell it to the next guy at a higher price. So people stop buying things for the utility of it. They start buying things because they can sell it to the other guy at higher price. And that psychological trend in a society is also one of the key aspects which underpins the bubbles. Uh,
okay. Let's move forward in the article. I know I will debate with you in future sessions about this idea of the whole bubble concept. I agree with you. You know, he talks about that when a market is misbehaving, it's either misbehaving positively, which is 12.5% when the market bubbles up, and it's misbehaving negatively in 2.5% of the time, which is a market crash, basically, where everything. So, you know, the assets are still producing, companies are still selling stuff, but now the prices are way undervalued because everybody has lost faith and the crash on the market happens. Um, so let's move on this article. And then I think in this next section, let me ask you this. He talks very interestingly the concept of using PE as a metric of the psychological state of the market and bubbling and crashing. What's your impression of this use of PE?
sure, PE is basically is a multiple, right? PE, but the price of the stock would be the earnings of the company, right, multiplied by a certain multiple. And the more optimistic you are about the future growth and future in general, the bigger multiple you are willing to pay for it. So PE basically is it tells you about the sentiment of the market. So this,
So
when we talk
technically,
about.
PE should talk about the future earning of a stock, right? PE should be based on what is the expected lifetime revenue or the next 10, 15-year revenue of a company. But in the end, PE becomes how much more or how much for a stock that you're willing to pay based on their current earning, right? So, but PE is being calculated on their current earning, and it becomes challenging in those companies which are net negative or net loss or net revenue negative or growth companies or startup companies where really a lot of this inflation happened.
Yeah, so PE basically is, you have earnings, of course, and if your earnings are, let's assume earnings are not growing at all, then you give a very reasonable multiple, usually 10 times. Warren Buffett loves to pay 10 times earning multiple. So you actually say the price would be 10 times earning. But when a company is growing, then you basically, the question is that what exactly would be the multiple, and you have to factor in the future. So the more optimism you have for the future, the higher multiple would you pay for that company. And also, here's an important point which we should remember, that as inflation goes up, uh, people basically are willing to pay lesser multiple for the future earnings, because when it is discounted to the present earnings, the value become less. Those earnings become less valued. So that's always the reason why growth companies, they suffer a lot in inflationary environment, because inflation, once again, if it's a 10% inflation going on, the earnings that you're going to make 20 years down the road is not as valuable as if the inflation is lower. On the other hand,
That's a
company
bit.
which makes money right now becomes suddenly more valuable in inflationary environment. So
Current cash is superior to the future cash because
yeah,
a dollar now is more powerful in earning capacity than a dollar 5 years down the road because there will be 20% inflation, for example.
yeah.
So it will buy, it will almost buy half as much in 5 years from now with a 20% inflation or something. So that's very interesting. I think this PE concept has always been very confusing and yet interesting to me because when you talk to value investors, they talk about very grounded PEs. They talk about the stock market overall PE, 10 years ago, 20 years ago. Now they talk about the PE of the stock market in general in terms of before the crash or before bubble and after bubble, like this guy is doing right now, Jeremy Grantham. But in the same time, as soon as you hit into a company that has no earning, net earning, is spending more than it's bringing in or bringing in nothing, is an idea company, the whole concept of PE become useless. And that has always fascinated me that when the way you talk about PE, meaning that you're coming from really that farm owner or grocery owner or a mom and pop shop or a shop which actually sells Coca-Cola or a Walmart that sells clothes. That's the way of looking at the companies, and the companies are selling some certain commodity. But that means that in a normal times, thinking if you continue thinking PE, we would probably avoid very good companies who are starting. If you don't look at the product, if you just look at okay, what's earning they have and what earning multiple am I willing to get. But you don't have to respond to it.
He actually in his article feels that PE hasn't decreased significantly. He actually is saying that the question is that with the rising inflation, why PE has not fallen so much? And he actually is saying that uh, fif- he actually says that PE will fall toward 15 times compared to the current level of explained PE of just under 20. He's saying that when people are the publicly known PE, what people talk about, the PE is this. He's saying that right now it's around 20, and he says that in the future it will fall down toward 15 base because inflation is rising. And then he talked about actual PE. He actually said that actual PE basically rose from 30 to 34. He actually thinks that there is actual PE and then there is an explained PE, right? I think by explained PE he means that a PE which is commonly, in the press and in the media they talk about the PE, the available information based PE. That he says that our best guess is that the level of explained PE will fall towards 15x compared to the current level of explained PE of just under 20x. So, but he actually thinks that the actual PE just rose from 30x to 34x. So, but what he's saying is that
So
multiple
he's
actually has
basically
risen.
saying is that companies are still getting paid for more than their future earning revenue adjusted for inflation. And my impression now, listening to you and reading him, is that he thinks that the revenues expectations are still higher than the actual revenues that are going to happen in the future.
Yeah,
Is that what your
that is true.
impression?
That is
He
true.
thinks that the companies will bring in less than everybody think that they will bring in.
You see, the sequence that he's explaining in this article. This is a simple summary of this. He actually says that when the super bubble burst, first step is basically the bubble is burst, stocks drop, right? And the drop basically is because of decrease in the PE. The expectations are now lower, so PE drops. Earnings basically are not changed yet. Then the next stage comes when there is a bear rally because people basically suddenly look at the stock and say, oh, the stock dropped from 100 to 50. It's cheap. I should just buy it. So then there's a very quick rally happens right after that drop. And then what happens is that earnings actually start dropping. And when the recession comes, for example, we are all expecting recession will come. So recession comes, earnings actually will start dropping. So now we have a double whammy. We have low PE and you have low earnings. And when you multiply them together, your stock price actually drops significantly. So basically what he is saying is that earnings drop, a next leg is going to be the earning drop, which is
So
going
we're
to
in the
basically
bear
crash
rally
the stocks.
where initially there was some PE adjustment that market started giving more sane multiple to the earnings, current earnings. But then the stocks became cheaper, so everybody who was waiting for a stock to become a little cheaper to buy jumped in without thinking too much
Yeah,
and bought that stock, and the price went back up. That's the bear rally
yeah,
that has happened
yeah,
in the last few
yeah.
weeks or so. And now we are gonna start getting hit by new revisions of the expected earning by all these giant companies
Exactly.
who are the major part of the stock index like S&P 500, who bring in most of the
Sure.
revenue. So all those
Mhm.
revenues will be adjusted downwards because of the
Yeah.
recession. And recession, we can talk big, but without going into too much detail, we're basically saying recession is because number one, inflation, and number two, that there is broken supply chains.
He actually talks a lot about short-term challenges and long-term challenges. He actually says that the world is
Let's
basically
go there.
yeah.
Let's jump over to that section. Let me share my screen again, and we can talk a little bit about those or go through it. So quickly, I jumped over the stages of Superbubble, but you highlighted that, Akil, so I'm going to skip it. And then this PE model we were talking about, and now it goes into the near-term problem and the long-term problems. So let's talk about that. Let me have you start.
So yeah, in the near-term problems, he actually talks about the problems. He actually says that the food problem, energy problem, fertilizer problem because of war in Ukraine, and Russia and Belarus, they account for like 40% of potash, which is fertilizer. So basically, because of that, the food prices will go up. That's one reason for the food inflation. Uh, and Then he talks about the China, which basically is a very big source of uh, most of the growth in the last 30 years in the world is by the China. So when we say that the world productivity is increasing, it's because China's productivity is increasing, and China's things are not going right. COVID is still going on in China, and Chinese property market is in a bad shape. So China is the situation is not looking good. So that is the second part of it, and then of course government is doing the fiscal tightening. Government is increasing the interest rates, and that also is going to basically put brakes on the economy. So if we
So
put
if I
all these things
summarize,
together,
from what you're saying is that number one, in general, there will be shortage of energy, and energy drives food, either by providing fertilizer. Fertilizer comes from natural gas and other products, and those are being diverted towards keeping everybody warm instead of growing more food. And then also there's supply disruptions and the war in Ukraine. So there's energy disruption leading to food disruption. But of course, energy disruption is leading to other disruptions too. But food is a key issue because you cannot live without the food, and there will be a lot of food war. So there will be price war on the price of energy because people would be willing to pay any amount to get their food, and that will really drive up the price of energy, and it will steal energy from all other work. And then he goes in to say China is a big producer of a big part of the engine of the economy growth by producing stuff from free and cheap energy and free and cheap labor. And they're running out of energy, waters are drying up, hydroelectric is going down, they have to burn more coal, and the labor is becoming short because of COVID pandemics and other issues. And then the real estate bubble is also bursting up, which is another issue for internally for China. And then lastly, US and Europe are starting to tighten up the liquidity, and euro dollar and dollar itself are the reserve supply of the currency, and that liquidity crunch or tightening will hit a lot of other problems. So you have less money to spend, and things that you wanted to buy are becoming expensive.
yeah, and he actually talks about like a lot of things coming together at the same time, which usually does not happen. So
Let's
inflation
talk
is
about the
going up.
long-term problem. Here I have a little disagreement from a couple of points that he made.
Sure.
Before I give my contrarian view, let me have you summarize what he mentioned as a longer-term problems.
Yeah, he longer term here is basically saying that in the developed countries, population is not growing, and this population decline is gonna basically put a brakes on the growth in the economy in the developed countries. Uh, Old population will go, their number will go up. Young people number will decline. People are not having enough babies. So slowing the growth of people, basically population growth, will also slow the growth of economy. So that is one thing. Then he's talking about climate change, and there are droughts going on. There are high temperatures, fires, floods. So that can actually cause a lot of problems. Uh, Mass migration and things like that can happen. And then, yeah. So basically, these are two big things that he
So let
talks
me,
about.
so let me give my contrarian view on this, and that's where I think some of the people I follow differ with some of the expert that there is that near-term problems. I agree completely for the next 12 to 18 months, maybe 24 months. But I think long-term problems, I disagree. So let's take these two. So one is the population issue. And what he's explaining is that in the last 50 or 100 years, the increase in productivity, so GDP, the gross domestic product, whatever you make, is directly linked with the growth of the population. So the more people you have, the more they grow up, more they produce, and the more GDP goes up. And that's true. That is what has happened in the last 50 to 100 years, that as you get more and more workforce, and that's why China grew so much, because it created a workforce, or got women into workforce. US did that, got women into workforce, and production of stuff went up. But I think the productivity of the future will not be human labor dependent. I think we are underestimating the automation and robotics ability to take over a lot of these menial jobs, which are very, very low producing. And then you can repurpose those part of the population or future generation into doing stuff. So a lot of, for example, maybe 1 million people are right now, we need, if we continue the current model, for job like making your sandwich, or cutting your lawn, or vacuum your carpets, or washing your cars, and so on and so forth. And all of that jobs will be the first one to go away. They're the lowest paying, they're the most dependent on labor, the profitability is strongly linked with it. Just this morning I was listening to the All In podcast, and they debated this law that got passed in California, where they were saying that in California now there will be a large union with government coordinating to do basically pay contracts with the chains, fast food chains. So basically, all McDonald's pay decisions in California state will be done at a state level by direct involvement of the state government. And there's already a number that the minimum pay is $15 in general in America. But in California, they're expecting that they will negotiate with fast food that you will have to pay $22 per employee of your fast food person who makes your sandwich or takes your order on the drive-through and things like that. And then they basically said that what would happen is that this $22 per person will become now an incentive to automate some of these things. Order taking, for example, in the drive-through. Why do you need one person standing to take your order? Right? They already have gotten rid of the checkouts, cashiers. When you go to McDonald's, there is this large iPad-like screen. You touch screens, and 90% of the McDonald's have gone to. Actually, last time I gave an order to a person was probably more than 6 months ago. You go to the screen, you touch the button, and an order is placed. Now somebody will get it out and will call your number or deliver it. Right? Similarly, the person standing on the taking drive-through, taking phone call, your voice call to take your order would not be needed probably in a year or so, especially if you have to pay $22 an hour to that person or more, right? So I think the population issue. Similarly, Tesla is making this humanoid robot to do factory line work. So someone who can lift something very heavy and do it repeatedly without getting tired, without making mistake. So an assembly line worker, Tesla is trying to figure out a robotic assembly line worker, which is humanoid. One of the challenge with using robotics. Sorry, I'm going too long, but I'm trying to make my point. So when Tesla Model 3 was launched, it was launched as a $35,000 cheap electric car, right? And part of the calculation was that they will use robots to do assembly line work. And that's how they started. And then for the first 6 months, they couldn't produce cars to sell. They had orders pending, and they keep on delaying the order production. Why? Because the robots actually slowed down car production. And they realized that the humans are much more efficient than robots in some of the tasks in the assembly line for car production, like running wire and harnessing and punching in a clip and things like that. So the solution that Elon kind of came up with was to make a humanoid robot, which can do with its hands and fingers the thing that a typical traditional robotic arm, which just swings this and swing that way, cannot do it. So you need a human kind of a robot, human shape or humanoid like robot to try to do the punch in the plug or punch in the wire and run the wire and things like that. And I believe personally that this is coming much sooner than expected. Let me take your response before I go to the climate part second.
Yeah, I think. Well, first I will point out something that you just mentioned, that Elon Musk changing the robot to humanoid so that the chain is not interrupted, because if one part of the chain is too fast, it creates a bottleneck for the next part. So weakest link basically become the deciding factor. There's a very good book on it. It's called Critical Chain. The writer's name is Goldratt, and one of the favorite books of Jeff Bezos. If you like to know more about it, that's a good book about like how to improve that any process which has multiple steps, how to optimize that. So now back to the population thing. I think a lot of things will be automated for sure. Not everything will be automated. For example, nursing will not be automated. For example, when we have too many old people, we need nursing. Physical therapists will not be automated. So I think what the needs as the old people number will grow, the needs that old people have usually cannot be automated. That is human needs, right? For which you actually need a human being. But you are right, a lot of things will be automated with its own social effects.
So my main point is that our estimation of number of people needed to keep growing is too high, and it's using the model that the current jobs will continue to be.
You got to realize that growth also, it's not only production part, it's also consumption part, right? If you are not going to produce much if there is nobody to consume it, right? So
well, that literally takes us to this debate on what exactly is money and what exactly is wealth. So, and that's what actually Lynn Arden's article that I really like is because she starts from that concept. She says, okay, you have $1 million, you think you're ready to retire, and suddenly the market goes down or inflation hits, and now that $1 million is not enough. Now you're 20% poorer, and things like that. So she talks about this concept, and and we've talked about this, that yes, the things will be consumed less and they maybe become more cheaper, but you're still wealthy. If you measure wealth in terms of how many Coca-Colas you can drink in a day, and suddenly there are less people who are drinking Coca-Cola, so that the Coca-Cola has to be sold for less, but you can now produce it for less by automating some of the things, and everybody can still drink 10 Coca-Colas, so now maybe they can drink 11 Coca-Colas a day, then you're not poorer, you're wealthier. Now, you don't measure it in dollar amount, right? So the revenue generated by Coca-Cola in dollar amount has gone down, so the stock price in dollar amount has gone down. That's how we're thinking about wealth. People will become poor because Coca-Cola price will be lower. Well, their Cokes will be selling cheaper, but each person will be able to even afford more Coke. So in that sense, there is more wealth generated.
No, that is in a sense true, but you got to also realize when there are less number of people or the smaller is the market where you can sell, also economy of scale goes away. So with automation, with the population, let's say population declines by 50%, right? Suddenly the number of people you can sell an item to decrease by 50%. You can say worker part, we can compensate with automation, right? But when you're selling it, economy of scale is a big part also. So when your number of people you can sell something to, and at some point automation might not make sense. With the 50% less people, the question is it worthwhile to install these $1 billion robots, for example, to sell?
Yeah, but they may not be $1 billion anymore, and it's basically another wealth is that actually if you measure in terms of time available to do things on your own, maybe we need half as many hours from each person to work as compared to what.
Well, that is true. Now. That's exactly how it should be ideally, but this is not how human thinks, right? I mean, ideally, automation, everybody should be.
That again gets us back to the current system, the current economic system of measuring things and inflation and all that. It has a lot of built-in presumptions, just like you talk about, it's a sales-based model. Oh, we need to sell stuff. It's a consumption-based growth. We say, we have, for us to say, okay, growth has happened, we have to show that there is more Coke being consumed, more burgers being eaten. And then, of course, you need more consumers, right? If you think in that way. But I think we need to start rethinking about what actual growth is and what wealth is. And in that sense, we'll do much better in the long run than because of the population, regardless of
that is true. The way we measure things is quite broken. The way GDP is measured, for example, that is quite weird. So, I mean, things are not measured in an exact way. Sometimes what you are
It's not
measuring
even measuring
has
exactly
nothing.
the whole premise of the current economy is that it's a consumer-based economy. It's a Keynesian model. The main linchpin of Keynesian model is consumption. And that's why it makes sense to give a lot of stimulus checks, right? Why do you give stimulus checks? You give it because you want to increase consumption, right? You say, send us money, and then money will go into the market, will go buy more stuff. Give everybody $2,000, you can go buy more TVs, and then that will rev up the engine of economy. That's a very bad way of thinking about economy.
Oh,
It's a
sure.
consumption-based model. And so we need to get out of this consumption-based thinking or Keynesian thinking about economics. And then climate is a whole big discussion that I can go on for long. Again, I think they are overemphasizing the climate issues. Yes, climate causes flooding of the islands and people get flooded. That is a big issue. But saying, oh, climate will make it harder to produce hydropower or this and that, you can solve all the power issue, just switch over to nuclear. And that's what
Yeah,
everybody's trying
you
to do
can
now, right?
actually.
Japan
See,
announced.
yeah, Danish, the problem basically, you got to realize that it's not that solutions don't exist. The real problem is that then again, they say who will tie the bell in the neck of the cat. The problem is not the solution is not the problem is that how is going to implement it. The political will does not exist. The same is, for example,
No, but see that we
with
should be
automation.
thankful to Putin because he convinced everybody to turn around and start using nuclear energy, right? The whole ESG
Well,
or
yeah,
economy narratives,
maybe 50
finally
years
somebody
from
punched a
now,
hole through it and he had to start a war to punch a hole through it because that's what was
sure,
needed to
maybe
stop this
50 years
madness.
from now, when the history of renewables will be written, probably this would be the main event in that story. Quite possible. But one important point that I want to emphasize is that there's a big problem with the human psychology, right? Ideally, everybody should be cheering because everything is automated. They should be cheering for it, right? Less work, man. Why should they not be cheering? But the problem basically is that because labor is a cost, so what ends up happening is that with automation, people get fired, and the ones which are left over have still same amount of work, right? So basically, something which is a virtue, which is a blessing, become a curse. This is a human story. Human beings pick something which is a blessing and make a curse out of it. Human beings do
But
that all the
really, I
time.
mean, if we go to the model that you often propose, just commodity exchange based trading, 90% of the stuff, you don't need to spend money to exchange with each other, really. And once you switch to that kind of a model, everybody will become a lot more wealthier. The current system is an exploitative system. It
If
gives unfair
you,
advantage to someone
yeah,
who already has a big capital in his pocket.
sure.
He comes in and he can now, take over whatever he wants. He can absorb a lot more instead because he's the same amount of producer if he was production based economy. But he can really control who consume what.
Yeah, that
But
is true.
anyways,
Especially, yeah, okay, let's move on to the next part.
let's move on and let's go on to the conclusion of this article so we can wrap up this video before we go on to the next article and next video. So he talks about this epic finale. So what do you think and how does this, he explains the previous Superbubbles finale.
So he actually says things that there are multiple asset
Everything's gonna
classes which are
crash,
involved.
basically.
Yeah, there are multiple classes which are in a bubble state. Housing is in it, stocks are in it, bonds are in it, right? And then you combine the inflation and then rate increase. So these are kind of so many shocks to the economy that there's a long way for everything to go. So basically, he actually talks about super bubbles
So
in
my impression
1989.
is that he says in the previous super bubbles, uh, things went downhill a lot more than what has happened so far. We are still we have started to go down from the bubble, but there's a long way to go down before this is over, right? And I think
That
we've
is
talked
true.
about it
That's
before
the,
that in
that's the
previous
gist of it, and I
crashes.
think that
I think you have
yeah, if
mentioned
there is
this
an action
previously that
plan which can if there is an action plan that we can make out of this article, is that it's not time to invest at this point.
So I think a good number to remember is 80%. We previously talked about. Typically, when a crash is complete, the commodities, the equities are down by 80%.
Yeah,
And if something has not fallen by 80%, then it means that it's still overpriced. I
yeah.
mean that, don't buy it because it's cheap, because it's only go down. What's his name? He talks about common pitfalls in investment. The guy who wrote Once Upon the Wall Street, One Up on the
Peter
Wall Street.
Lynch.
Peter Lynch.
Peter.
So Peter Lynch talks about the common myths in investment, and one of the myths he talked about is that because it has already gone down so much, it will not go down any further. So it was selling for $10 and now it's selling for $3. Oh, this is so cheap. This is barter. It's like anything can go down even for as long as it has not hit zero, it can still go down. So if it goes down from
Yeah, he
$3 to
talks about
$2,
some
that's a
stock.
33% drop.
Yeah, he talks about some stock which was like he bought like 40, and stock dropped down to like 20, and he was telling everybody to buy it, and then stock came down to like $4, and people are asking, should we buy it? It's like, I don't know, man. At $4, it's like, what can I say? It is stock dropped from 40 to 4. How can I?
Yeah,
How
so the
can I
bottom
now
line is that
promote?
just because stock has dropped 50% doesn't mean that it will not
Yeah,
drop
it
another
does
50%.
not.
Going down from 40 to
We are
20
all
is
human by this
50%.
time.
Yeah. And from
Anybody who
20
has
to 10 is
invested,
again 50%. And 10 to
anybody
5
who
is another
invests in
50%.
stocks, anybody who invests in stock can relate to this experience. Uh, you say, well, this stock has dropped 50%, it's a good purchase, and it's a big mistake. I mean, it's just things can
All
always
right.
get
So
worse.
with that positive note, let's stop here. I will share the link to this article in the notes for this video. And thanks for the book recommendation. I'm trying to collect all of your book recommendations so that we can list them separately or create shorts around those book recommendations. That's very good because most of those books I have not read yet either.
Oh,
Thanks for sharing those.
I can actually show you. That must be sitting somewhere. The chain that I told you about. But here's another book by him. This book actually is Gold Rat. His writer's name is Gold Rat. The Goal.
Hmm.
Same writer. So, but he was an expert in these kind of, production systems, how to increase the production and stuff like that. He wrote quite a few books actually.
All right. Thank you very much. Let's stop here.